He and I actually spent a lot of late nights trying to sort out exactly what you were just asking, which is what does a bubble look like? How does it come up? Particularly, those big ones, the ones that we remember generations after they've happened. When it comes to the really big bubbles, it tends to be that, yes, of course, there is the irrationality, the madness of crowds, which tends to be ignited by something that feels like a technological change. Technological change, of course, is a natural term for the era that we live in, whether it's the internet revolution, the AI revolution. The moment you can say revolution, you're in pretty good shape coming up with a technological change that's changing things in a profound way. Could we see prices come down substantially, 20, 30%? Certainly in some corners, no question. Does this qualify as one of the great bubbles in history? I just don't know.
Hello and welcome to the Achieving Alpha podcast. My name is Stephen and I am the host of the show. Today, I'm delighted to be joined by Jonathan Treussard. He is the founder of Treussard Capital Management, and previously, before that, he was the head of product and a partner at Research Affiliates. Welcome to the podcast, Jonathan. Really great to have you on.
Thanks for having me.
How are you today? How was your day off yesterday?
Absolutely fabulous. We spent a lovely time as a family, so that was great.
That's all you need. Awesome. Well, it's really great to have you on the podcast today. I'm really looking forward to a really comprehensive discussion with you. We're going to talk about a lot of different areas. So I'm really looking forward to that. And we're going to be delving in today to what forms bubbles and how bubbles form in markets. So that's going to be a really interesting subject for us to pick apart. So, just to get started today, as it's your first time on the show, I wanted to get a little bit more about your background, how you started in investing, and just a little bit more about you and your journey.
Sure. Well, none of this was supposed to happen, I guess is the best way to describe it. I was born outside of Paris, and I grew up thinking I would be a musician, a professional musician. So when I was 17 years old after graduating high school, I flew out to Los Angeles by myself, thinking I'd be a professional musician. And very quickly, I drifted into school, which was very fortunate. I ended up being, pretty good at school, which took me to UCLA. I met at UCLA a mentor, a guy by the name of Earl Thompson, who actually taught me a lot of economics in general. But this was, kind of the early 2000s. We're talking 2001, 2003, roughly, as the tech bubble was bursting. And so he and I actually spent a lot of late nights trying to sort out exactly what you were just asking, which is what does a bubble look like? How does it come up? Particularly, those big ones, the ones that we remember generations after they've happened. I graduated from UCLA. I was by then, massively passionate with economics. I honestly wanted to be a professor. I wanted to be Earl, to be more descriptive. So I applied to doctoral programs. I got into a couple of doctoral programs, one UCLA without financial aid, and Boston University with a full presidential fellowship, which meant that I would be getting paid to get my doctorate. So I think this might have been, my first truly economically rational decision, moving cross country to go to BU for my doctorate. So I did that for the first couple of years of the doctoral program. You're put through the paces of micro and macro and econometric and so on and so forth. And I really did fall in love with microeconomics in the context of making decisions under uncertainty, which is really what a lot of modern microeconomics is about. And in my second or third year, I walked into the business school at BU and I met a guy, Zvi Bodhi, who said to me, well, everything you like about economics in the real world, we call it investments, where we call it finance. So how about you do that instead, which I did. And that's how I got into the space of investing, the space of thinking enacting very much as I just described to you. How do you make decisions under uncertainty? Well, that sounds a lot like financial markets. I learned a lot of my finance from people around Boston, including Bob Merton, who, I became an option theorist by training. And in fact, Bob gave me my first job while I was still in grad school, which was really great. I got to spend a little bit of time in New York as well as Boston. By the time I completed my doctorate in late '07, early '08, it became pretty clear I really didn't want to be an academic. It seemed like there had to be, richer experiences out there, more interesting experiences for me. And so I ended up moving to New York to join the Ziff family office, Ziff Brothers Investments. And that was June of '08. And I joined a very and a very intentionally growing risk management group. So it was me and two other newly minted PhDs with whom I'm still very much friends to this day. And so we helped ZBI, Ziff Brothers Investments, through the financial crisis from the seat of risk management. So that's the how I got into this thing to start, if you will. And as you noted, I then, having gone to UCLA undergrad, I had a taste of California. We had kids in New York. I thought there had to be a better way, so we ended up moving back to California as a family. I was partner and head of product at Research Affiliates for a number of years, which was a fabulous experience working directly with, wonderful people, including my boss at the time, Katie Sherrod, who was the CEO. And in 2021, Katie retired. I left Research Affiliates thinking I would be going back to the family office world, which, I did for a minute. But then in early 2023, I launched Treussard Capital Management, a boutique wealth management firm that is, the sum total of my experience in the service of wealth management clients. So that's the full journey in, under 5 minutes.
Awesome. Really good to get some color and some background into your career. Um, I heard as well that you were previously a musician. I want to ask you, do you still play? And what kind of shaped that career change?
Yeah, well, I still play every day. Music is a huge part of my life, no question. Again, it's the reason I moved to the U.S. in the first place. So yes, I play music nearly every day, predominantly for the household. But it's a really great. It's a big part of my life. It's a big part of how I find peace and centering, that sort of thing, for myself. And what created the shift was incredible great fortune. I mean, again, I mentioned a couple of my mentors along the way, academic mentors. But in my first week in LA, I met a kid who honestly probably did more to change the course of my life than most, who said to me, "Well, I know you're here to play music in the US, but if you want to stay here, you may want to get papers, immigration papers." Which, I'm a 17-year-old. I'm not sure that I was completely kind of tracking. And he said, "Well, the easiest way to do that is go to a community college and get a student visa." So I that's how I drifted into school. I started at Santa Monica College. I loved learning and studying. It turned out I was really good at it, which is how I then ended up at UCLA. But yeah, it was one of those things where sometimes, a little angel taps on your shoulder, I guess.
I'm sure it was very different from France. So you'd grown up in France and then you'd moved over to US. That must have been a bit of a culture shock as well, right?
It was, and in a lot of ways, it was a very welcome culture shock, particularly as you remember 25 years ago. I think the differences were even possibly starker than they are today, where France was a very rigid education system, where if you hadn't made a forever decision by the time you were 17 or 18 as to which path you wanted to go toward, things got complicated, and America was the exact opposite, where you could kind of muck around and sort things out, and you had the opportunity to try a lot of different things. At Santa Monica College, I took economics, I took political science, and I took opera. And all of that made sense.
You had the opportunity to try out the American dream where everything's possible, right?
Correct, and it worked.
Yeah. I know as a fellow European that sometimes you do get pushed into a certain way being in Europe, but I know that in the US it's kind of encouraged to explore different opportunities in different areas and build your character as well as your experience. Yeah. Great. All right. And I wanted to ask you as well about Treussard Capital Management and what you're doing there. What services do you provide and how do you work with your clients?
Sure. Treussard Capital Management is a boutique wealth management firm, financial advisory firm that serves households predominantly. And again, it brings the sum total of my experience to the task. I tend to think that obviously from an investment standpoint, a lot of the knowledge that I've accumulated over the years is critical. I talk about an iOS, an investor operating system that really requires three things: actually knowing the mechanics of investing, digging in on the psychology of investing, and three, getting clean on the end goal. Why? And so that's the way we organize many of our conversations with clients. Um, but a huge part of it too is my sincere belief that for a lot of people, call them kind of mass affluent to high net worth, they fall through the cracks of the machine, what I call the wealth management industrial complex. Look, by the time you're again a billionaire like the people that I used to serve, you have a family office, you have fully aligned investment staff, and so on and so forth. But for a lot of people that have had the great fortune of generating some wealth in life, but not to the point of having their own family office, they often find themselves in this wealth management industrial complex where, when you ask them, do you feel like you're the client or the product? Very often they start to, look hard at that and say, I'm not sure that I totally feel like I'm the client. And so that's what I do for people. I really help them reclaim their understanding, control, and agency over their own wealth.
Yeah. I think it's really good to provide kind of tailor-made solutions for clients because everybody has different background, different level of wealth, different investing experience. So if you can do that, that's really beneficial for your clients, I'm sure.
That's absolutely right.
All right. So if we dig in now to more what's happening in the macro environment, I just wanted to start off and we can start off with a kind of more broader picture about the macro environment. And if you could provide a snapshot into what's happening in the macro at the moment. And then from there, we can then dig in further into the details.
Absolutely. Obviously, the macro picture is incredibly complex. I actually made a presentation at the beginning of this year called "Ready for 2024," and it again leveraged the way I think about the world, and honestly, the way I think one should think about the world, which is this is an uncertain place. And so we talked about three different scenarios, the scenarios that were on the table going into 2024: the soft landing that everybody was somewhat hoping for but also making fun of at the beginning of this year, the concept that somehow the Fed could engineer the type of economic slowdown which could achieve the dual outcomes of lower inflation without completely destroying the economy. A hard landing, that would be option number two, which I guess failed to do that, and of course would actually create significant damage and harm to the economy, US and global. And then this idea that actually a reacceleration was underway, and try as they might, the Fed might not be able to, keep inflation under control and do all these things. Then, as well as now, I was a proponent that in a world where all of these three scenarios have distinct probabilities attached to them, all of them possible, the soft landing scenario seemed like the one that was playing out. And again, I tend to think it's fun to joke about the Fed and make fun of them, but the reality is that seems like a cheap trick. They are well-intentioned people, true public servants, and they tend to be pretty well educated within the limits of what we know about how the economy works. And so I was one, willing to give him the benefit of the doubt, and two, it seemed pretty clear that the picture was trending in that direction. And I continue to think the picture is trending in that direction. Back in January of 2021, everybody thought we were getting reacceleration. I think reacceleration is clearly, not what's playing out now. The idea that inflation was going to pick up again, and we just couldn't stop this runaway train of the U.S. economy. The hard landing has an appeal, which is all good things tend to have their own seed of destruction within them. And so, over the fullness of time, is it possible that we will be getting a hard landing? Of course, but that's just literally letting the clock run. Look, as far as I can tell, the inflation emergency is over. It doesn't mean that we like the prices we see at the grocery store, but the rate at which prices are rising is now, generally speaking, settled. It's not necessarily what we would want it to be 2%, it's closer to 3, but it's pretty clear that the inflation emergency has passed. We always knew that the easiest way to finally get to that outcome was to, have labor take a hit. And so, yes, of course, the picture on the labor side of things has clearly softened substantially over the last few months, and that's not surprising, and it's also not. As hard as it is to be detached from the fact that it means that certain people who need a job are having a harder time finding a job, so on and so forth, but it is as it should be. The idea that, the day you need a job, you can get a job the next day is how you get massive wage inflation, is how you get some of those things. So I think it's just, we're seeing a reasonable softening of the labor market. And then finally, there's all the other stuff. Today we're seeing, manufacturing in the US contracting again for a series of months, I think going back to April. All right, well, that's not great, but let's also remember do you remember how much manufacturing grew, over the last few years? Never mind the fact that manufacturing is not the key driver of the US economy today. So I think it's worth putting all of these things where they belong. And so, yes, we're seeing an economy that's slowing down, a US economy that's slowing down, no question. And I don't think anybody's confused that it was kind of necessary. And if it stays on this path, it'll be well worth it.
So, are you more in the camp of a soft landing is much more likely? Obviously, inflation is started to kind of come under control. They've left rates quite a decent period of time. We've seen unemployment tick up a little bit, but I think the main mandate was that inflation came down because it was kind of running out of control for a period of time. Do you think that now, if they start to reduce the interest rates in from September onwards, do you think that they've timed it quite well? And do you think they've got to it in time to ensure that we don't have a harder landing than needed or anticipated?
I just don't know how to have an opinion about that. What I mean by that is very simple, which is we can dispute whether they should have done it a few months ago or wait another few months. I think no one's on the side of, wait longer, that I can tell at this point. Um, in a world, again, in which, making decisions under uncertainty is incredibly hard to do. I'm reminded, I mentioned my former boss, Katie Shared. Katie and I spent a huge amount of time talking about culture at research affiliates, and what a healthy culture looks like. And we talked about collective intelligence and, those types of concepts. It seems to me that Jay Powell, believes in things like collective intelligence and getting feedback rich conversations before making decisions. Look, in early 2020, when the world was literally coming to a screeching halt, there was no time for debate, and they acted in an incredibly swift and extreme way. So I don't think we can accuse them of being systematically slow. Now, we all know that, inflation was allowed to kind of run nuts in 2021 before they started raising rates in earnest. So they were definitely slow there looking back. But this one just seems like it might just be in the middle of the distribution. Could we have saved a few jobs by going a little bit early? But yeah, but then you don't know that you would have actually not gotten the reacceleration that we were, worried about at the beginning of this year. So this seems, I hate to say it, but in a world in which A plus is very hard to achieve, in particular, until we have enough time to really analyze the impact of a decision, this seems like a solid B plus. Uh, you know, so that's the way I would think about it.
Yeah, I think it'll be something to look back on in hindsight, right? When we know how it happened. I mean, if they would have gone a little bit earlier, who knows? Inflation could have spiked up again, and it could have caused longer term problems. Or if unemployment hadn't gone up, then they may have kept rates higher for longer.
And it doesn't mean, please, I want to be clear to, you and your audience. It doesn't mean that we shouldn't be worried. It is unequivocally true that unemployment has ticked up from the bottom. And if you look at a chart of unemployment through the decades, it is it is not a standard pattern for the thing to go up a little bit and then just sit there. Unemployment has a tendency to snowball. Um, so, but again, I think I guess the point is, I really don't know that achieving perfection was ever in the cards. And so, from that standpoint, could it be that we end up with something that feels harder than necessary? No, of course. Has the Fed have they had a history of eventually manufacturing recessions? Yeah, you could say that. But a recession isn't the end of the world either. It might just be a necessary part of the readjustment.
Yeah. And I think the fact that the Fed have a dual mandate just shows that perfection is never on the cards because it's impossible for them to sync up both of those dual mandates to be perfect.
That's right.
Yeah. Okay. And I've heard you talk about before about wealth inequality in the economy. If you could just explain a little bit more about that and how wealth inequality really affects the economy.
Sure. It is unequivocally true that wealth inequality is substantial and has grown over the last few decades. And wealth inequality is linked to another much more kind of financial market concept, which is the profit, the way corporate gains are split between labor wages and profits. And it's very clear that we're, at some version of all-time high profit share, so that the gains from economic activity are accruing predominantly to shareholders. All of that put together just means that we have the system has one positive and many, many negatives, I guess is the best way to put it, to the extent that very wealthy households in the US in particular represent a substantial amount of the stock of wealth and therefore the stock of disposable income in the country. It creates a resiliency, which is, let's get real, when you're very wealthy, you are less sensitive to economic cycles. You're not going to go from 4 vacations a year to no vacations a year. You're probably going to go from 4 vacations a year to two, that sort of thing. Now, so that's one way to think about it, which is um, oddly, I believe that the wealth inequality that we are witnessing is creating more resilience. And therefore, it's been harder to slow this thing down. which is, again, one of the challenges the Fed has been having. The Fed very much believed, I mean, you can go back to the public record. The Fed very much believed that they were going to, hike rates and housing was going to really slow down real fast. Jay Powell got on stage, I think it was in 2022 maybe, and said, hey, young households, stop buying homes, these are going to get cheaper, you can get them on the cheap later type of thing. I mean, I'm paraphrasing, obviously that was their belief, but wealthy households just kept the housing market going. That's what happens when you can pay cash. The interest rate doesn't matter. On the other hand, it is pretty clear that it creates, societal tensions that are very hard to put to rest. And we know that a healthy economy over the long term requires, something that resembles a social compact. And our social compact is without a question in my mind, under significant strain. So it's a messy reality that this is what we get for running the system the way we're running it. It's whatever Charlie Munger used to say, show me the incentives, I'll show you the outcome. Well, here's the outcome. And the question is, can we somehow thread the needle to a more balanced version of this, where this is unequivocally and necessarily capitalism, because it's the only thing we have to move this train down the track.
Yeah, I agree with that. And I think it's the differences as well between property owners, equity owners, and their owning class versus the consumer, right? So you've obviously had record numbers of uh, people from lower demographics, economic demographics, where they've been borrowing money on their credit cards. There's been more and more delinquencies and higher rates, and they're really struggling. But the owning class have actually probably done quite well from the interest rate increases, right? Because it's allowed them to get more for their money.
Yeah. It's look, if you are in the business of investing and lending, if you have, significant wealth, 5% interest rates on treasury bills is a wonderful, wonderful gift. And that's that, we should never dismiss it. The reality is, and by the way, everything you just said is also correct about the people that are struggling. I think there is, and that's the social aspect that I was describing. It has economic impact for sure, but it also has societal impact where, we're all looking at each other being like, I used to think we were like on the same program, but I don't think we are. But to your point, I mean, look, as someone who helps people by managing their wealth and their financial assets, like I don't want 5% T bills to go away. 5% T bills are like fabulous, right? But it inherently means that the people that can lend to the government have been doing very, very well. And the people that are forced to borrow have been struggling. That's just the nature of things.
Yeah. Okay, and before we shift gears to talk about bubbles, I wanted to ask you, we've mentioned some positive things in the economy, we've mentioned some negative things in the economy. Is there any areas that you see as a big concern? So I don't want to say black swan events because black swan events, we don't really know what they are. So we'd maybe mention maybe some gray swan events, anything that you can kind of see on the horizon, anything that causes you some concern and makes you think more about.
On the Let me try to make a distinction between the economy and financial markets. We know they're related, but they're not the same. On the economy side of things, look, I repeat, a gray swan is what happens if unemployment really gets going. It is it should not be dismissed as a possibility. So that's a gray swan because it's not like inconceivable. You look at literally the data going back to the 1950s or something, and it's pretty clear that unemployment spikes are more likely than not once unemployment rises off of the bottom. That's one. Number two is, and I wouldn't call it a gray swan. I wouldn't call it a black swan. It might just be a white swan because of, all you have to do is look out the window. The geopolitics that we're facing today are, unlike what we've seen in at least a generation. And I just don't know how we resolve these without tripping a wire. Whether it's the geopolitics of the superpowers, us versus China predominantly, the geopolitics of aggression, the Western Bloc call it, against Russia and Iran and so on and so forth. And of course, the geopolitics of what's playing out in the Middle East and the aggression on Israel, which clearly um, we're sitting, 10, almost 11 months into this conflict, and we should all hope for resolution shortly. But hope is not a strategy, as we know. So that's the that and look, if these are cheap cocktail party comments, but we know that if crude oil spikes, it will have a rapid impact on the economy globally. We know that if we really get into a tight spot with China and all of a sudden global commerce comes to a screeching halt, it will have very rapid, very important impact on things like inflation and economic activity. Um, then there is the financial markets side of things. And financial markets, in my view, are probably a little bit more fragile than the economy is because we've had so much good fortune, because we've dodged so many bullets, if you will, and because living through the last couple of years of very high interest rates relative to history, there's been a natural inclination and belief that the best thing you could do was to kind of hang on and hope that interest rates would come back down substantially. And we know there some rates have come down and some rates will come down, but will they come down enough to bail out the people that are hoping for bargain basement interest rates? And I just don't know that. So I worry about things like office, commercial real estate, where I think the world has changed in a substantial way. People used to be willing to pay, to put it simply, stupid valuations at the height of that cycle. And from stupid valuations to normal valuations, there is a big old gap in the middle. So, could it cause trouble? Absolutely no question. Will it be systemic in nature? It's hard to know. I would think the magnitude has the potential to be systemic, but again, we know that the more likely candidate for pain when it comes to things like office CRE is banks, local banks, and professional investment funds. That is that going to the banks will get bailed out because we don't know what else to do. And some investors somewhere are going to take a hit, but again, that's the nature of being in that game. So that's one that I would highlight. We can talk about valuations. I'm sure we're going to talk about valuations later, about certainly as far as equities are concerned. But it's pretty clear that things like credit spread are very tight. Now, does that mean that doom is upon us? Probably not. But it means that if things go badly, there isn't a lot of give in the system until really bad P&L is realized, and people are like, what is this thing worth again? I forget, because I thought it was worth $100 on the 100 cents on the dollar. Um, so yeah, it's tricky. Those are some of the gray swans out there.
But it's better the devil you know, right? It's better that you're aware of all these potential risks, and that does then help you to plan and decide what level of risk each one of those potential components are, which helps with the overall.
For sure. Yeah, I mean, that's the nature of risk management, right? One of my first boss in this business, Ali Crawford, always said, yeah, failure of risk management is failure of imagination. And so, yeah, it's helpful to know what could happen, knowing full well that it likely won't, or we shouldn't assume that it will, because that's another cognitive bias. People walk around just assuming that all the bad things they can come up with will happen, and that's not a healthy place to operate from. Um, So yeah, so I mean, look, and then there are the things where the plumbing is put in under too much stress. Do I worry about a nuclear bomb flying? For sure, because that would be, horrific. But do we know how financial markets would react? Like, I don't think we do. And I think again, like this idea that, I mean, I think we all know what the natural instinct would be, which is people would say, sell, 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 go buy a bunch of treasuries, that sort of thing. But it's like, I don't think the treasury market is as liquid as people think it is. So what happens when it becomes a one-sided market? All of those things.
Yeah. Yeah, you have to take it all into consideration. Okay, and that's a good segue to talk about bubbles. I know that you've had quite a lot of experience before about researching bubbles. I wanted to start off by asking you what your experience is with bubbles. And before we go into what might potentially be a bubble, it's important to pinpoint and define what is a bubble. And maybe we can talk about some of the previous bubbles that have occurred in history as well.
Sure. So I spent years again working with Earl Thompson in particular, trying to understand the psychology and the mechanics of bubbles, the large ones. They're micro bubbles all the time. People get excited about all sorts of things, and they're silly and they're wrong, but they're just contained. Um, Meme stocks come to mind at the risk of offending the thing that's glowing in your background. Crypto comes to mind. These are, irrational, weird things that happen. When it comes to the really big bubbles, um, it tends to be that, yes, of course, there is the irrationality, the madness of crowds, which tends to be ignited by something that feels like a technological change. Technological change, of course, is a natural term for the era that we live in, whether it's the internet revolution, the AI revolution. The moment you can say revolution, you're in pretty good shape, coming up with a technological change that's changing things in a profound way. But one of the original bubbles that is worth looking at is the South Sea bubble of the 1620s in the UK. And that was also a technological change where we had the combination of joint stock companies. This is a technological innovation. People can pool resources together and go kind of pursue things, but importantly, transport and the idea that there's a big world out there, and if we can get there, and if we can get our hands on the resources, we can bring them home and create wealth that way. So the great explorer era, commercial explorers, we'd had explorers on behalf of the nation state before that, but this is commercial, seaborne exploration. So bubble check number one is, some version of, can we speak to a technological change of a revolution of some sort. And by the way, one of the things, we'll give Earl all the credit for this. If we have a paper, a working paper out there, and if you look through it, at somewhere that we wrote this in 2003, maybe 2004, and Earl basically was like, oh, and by the way, the next thing will be a real estate bubble. And of course, he was right, and we know that ended very, very badly. I'd like to take credit for it, but I was a kid, and he was explaining this to me as much as he was explaining it to others. Um, and that takes me to number two, which is, of course, private um, excitement, overexcitement is a requirement for a bubble, that people just get really kind of going on a theme, and they're willing to kind of look past rational pricing, that sort of thing. But it really helps to have if you want to put it gently, I would say regulatory capture. And if you want to put it less gently, I would just say an abrasive, callous government. Um, that basically allows for this promoter class to really get going without putting guardrails on them. The obvious version of the 1620s South Sea bubble, and again, I know this is from your history, so I'm sure you have better context than I, but the simple version of it is the Stuarts come down from Scotland to rule England, right, in 1620, and basically the Scottish court looks around and they say, we don't really like these people from around here. So if there are people out there that want to kind of abuse them, we're not going to get too hung up on that. And that's how you have people like Isaac Newton losing all of his wealth in the process. So that's part of it. The US tech bubble was fairly comparable, probably not as extreme, but it was pretty clear when you looked at the moves that were made on the regulatory front through the 1990s that they were pro tech firm, pro IPO, pro let's get this going. And in a lot of ways, the investor class was less protected than they had been before. So that's the way to think about it. Today we have unequivocally high valuations in many corners, and as far as the quote unquote revolution theme, we have that in spades with the AI thing. I'm struggling to get a read on whether the regulatory environment is sufficiently captive that the second requirement is met. I guess I'm not convinced yet. So, which is why I worry about using the term bubble too, in too much of an easygoing way today. Given where valuations are, could we see prices come down substantially, 20, 30%? Certainly in some corners, no question. Does this qualify as, one of the great bubbles in history? I just don't know.
Yeah. Yeah, it's very interesting. So you think probably the closest thing that we have to a bubble right now, I'm not saying that it is a bubble, just like you're not saying it is a bubble, but do you think AI is probably the closest thing that we have to a bubble at this current time? And how many of the checklist does it tick off?
Yeah, so valuations are, so the excitement is palpable, as we know, though I think the excitement is might have turned. I mean, the peak excitement, phase one anyway, might have hit, its pinnacle in some version of July or something. Um, and I do think maybe, and look, I'm thinking about this in real time, as I always am. I continually refine the way I think about things, including because of the prompts from conversations. We know that there is a societal, governmental mandate to win the AI race. We know it from the Chips Act. We know it from just this perception that we're now facing a zero sum game when it comes to this stuff from a military standpoint, from a global security standpoint, particularly between us and Russia. But I would argue that a AI rich, I'm sorry, did I say Russia or China? Particularly when it comes to China, but we know that an AI rich Russia or an AI rich Iran probably wouldn't be great either. So AI has a lot of potential to be let free to run, if you will, and encouraged to run in a lot of ways. When I talk about NVIDIA in particular, I say, look, I tend to think, that, given my history, behavioral forces are really important and the psychology of markets and all of that. And I'm sure there's part of that in the NVIDIA story where, everybody wants to be part of this grand adventure, and it's very feel good, right? To be making a bunch of money because we're changing the world. But I actually think a lot of the price action as it relates to NVIDIA last year and this year can be explained from a rational market standpoint. I don't think this is an irrational. This is not solely irrational. I think there is a lot of rational forces. First is it is unequivocally the case that earnings have grown dramatically. So that's not like the tech bubble of the early 2000s. Now the question becomes: do we really think that this hyperbolic growth is going to continue? And that's I'm less sure. I'm less certain. which is how you end up with valuations that test the limits of comfort, 30 times revenue, that sort of thing. But if you think about NVIDIA's price action, there is a lot that can be explained from a more rational standpoint. And again, I think we're very well served to accept that markets can be driven both from a behavioral standpoint and a rational standpoint. I don't think one being a dogmatic person in one side of the ring, it makes for a very interesting conversation and a very rich way of thinking. Look, there's a huge amount of what I would call geopolitical beta, and we know that, right? I mean, I've assumed for months now that despite all attempts at making sure the chips weren't making it to China, that there was a whole system, a whole pathway, a very expensive pathway to smuggle these things into China. By the way, I think there were some reports of that last week, so that just seems painfully obvious that it would happen. And again, it would explain why the chips are going for as much money as they are, because there is quote unquote legal demand, but also kind of black market demand. And here we are. The other part of it, never mind the geopolitical risk, which is if we get serious about actually splitting the globe in two, then that's a very bad day for NVIDIA. The other part of it is, and this is where the behavior and the rational meet, is there's been a huge amount of capex going into this from companies in the US and around the world. If the economy really does slow down, kind of leaning further toward a harder landing rather than a softer landing, and CFOs at companies around the world and certainly around the US start having to get righteous as to, where are we going to be spending money, where are we not going to be spending money, then my suspicion is the marginal CFO that's not, at Google or Amazon is going to say, hey, that cool AI thing we're working on to like sell more cars, maybe we give it a minute. And so there is, a lot of economic beta, a lot of economic risk that this is going to look really great until we hit, a softer patch, and then all some of that capex expenditure would naturally be delayed.
Yeah. My main concern with NVIDIA is obviously the valuations are very high. Some of it's warranted as the revenues and the earnings has increased pretty significantly. But I do start to think that a lot of that growth is already priced in. And I think what is not being priced in is competition. And I don't know if you agree with me on that, but I think that the valuations are really saying that there's not going to be much competition for NVIDIA going forward in the future. And there could be lots of later entrants or current entrants that come and take some of the pie which has already been put into the valuations. What's your views on the valuations of Nvidia?
Absolutely no question. What you said is correct. Again, I said, because I sincerely believe this, capitalism is the only force we have to pull this train forward as a society. Capitalism is predicated on competition. Do we not think that, serious people, not like I'm going to be making chips, that's ridiculous, right? But that serious entities are looking at NVIDIA's gains, real gains, not stock market gains, and saying, those revenues, I could use a piece of that. That sounds pretty good to me. And am I willing to throw, a handful of $1 billion to get ahead of this, proposition? For sure. So yeah, I think the idea that NVIDIA is a forever monopoly. Um, Look, is it hard to get into this game? No question. We all know that. How expensive it is in R&D and foundry and all of this stuff. But monopolies have a way of getting a little cozy, a little. I mean, and we know that NVIDIA is an incredibly hard charging culture. So I'm not accusing them of getting lazy, but the reality is, how many monopolies have we seen in the past that have suffered, decline in competition? Whether it's BlackBerry versus the iPhone, which, I mean, my short version of it is BlackBerry had a monopoly for a number of years, or, closer to home from my previous experience at research affiliates, what I would call legacy index providers versus disruptors. I'm reminded that, not so long ago, if you thought indices, you were really down to, S&P and Dow Jones and MSCI and FTSE and maybe Russell. And S&P and Dow Jones merged, and FTSE and Russell merged, and all of a sudden, you've got these massive, massive entities. And someone in Germany says, well, that seems like an odd kind of set up. It seems very monopoly pricing prone. And is there a solution? And this is a free plug, but my good friend Stefan Schäuble, who runs Solactive in Frankfurt, Germany, I think, is having a huge impact on pushing the status quo in index provision, where ultimately financial indices were really kind of under, at least if not a monopoly, kind of a cartel situation for a number of years.
Yeah, I think you need competition to keep you on your toes, but we all know with competition it does have its drawbacks as well, because when you have more competition it's going to start to eat away at those margins. When you're a monopoly you can have much higher margins, and then that all gets priced in when you have more competitors as the margins come down.
I mean, look at Intel. Again, like Intel was, a national champion and a top dog, and Intel's like not that as far as I can tell.
Yeah, not anymore. Definitely not what it used to be. Okay, and if we look at the valuations now in the US and in Europe, I want to ask you a two-pronged question here. How does the valuations in the US compare to that historically, compared to other periods in the markets? And then also, how does the markets in the US compare with the valuations in Europe and further afield?
Well, look, the reality is, again, valuations in the US are, if not where they were during the tech bubble, they're definitely very high. Not so long ago, I don't want to say today because I haven't looked at the exact statistics in a little while, but not so long ago, they were, in the 97th or 98th percentile of all history in terms of valuation ratios, things like the Schiller PE, so on and so forth. And nothing suggests, that's changed radically. Um, so large cap US stocks are expensive. Now they're expensive for a lot of reasons, and they're expensive for a lot of good reasons, right? I mean, it's the part of it is the long range argument, which is innovation continues to happen in the US. Earnings per share growth is certainly much higher in the US than other markets. So you get actual growth in the companies that you invest in. But the reality is that's all background, and it's supposed to be captured in things like a PE ratio. And we're at, very high levels of valuation today. So does it make it wrong? I repeat, it's hard for me to people obviously want to say things that are attention grabbing, but we owe people a more subtle and refined conversation. Is this a bubble? Hard to know. Is this expensive? No question. Which means if things do go badly, there is less, as the expression goes, margin of safety. So could these stocks that have gone up 20%, 30, the stock market has gone up 20, 30% in a year. And by the way, no one was like, this is outrageous, right? Everybody was like, this is great. Could it give back 20, 30%? Yeah. And people will scream bloody murder because it hurts a lot more to lose than it tickles to win. But that would not be surprising given the nature of where we are. I'm not predicting it. I'm saying the setup is such that we could give back a good amount of price appreciation to get to a place where the psychology of markets says, okay, now we know what this thing is worth, and we're happy kind of going back in. So that's the U.S. market. But European equities are not nearly as expensive, and for a host of reasons, historic and current. There's a lot of, Europe is always struggling with risks of many kinds, but we know we've got a lot of risks on the table right now, with everything from just the economy to the fact that we have a war at the doors of Europe, the politics of self-governance in Western Europe and what it means to be part of the European Union. So the European stocks tend to be more at the margin. It's not completely true because we have a lot of staples in there too. But there's a good amount of oil and gas, and there's a good amount of luxury brands and stuff like that, which means that if the economy does take a hit, these stocks wouldn't be doing great. And as a result of that, the current valuations are lower. So that's the good news, bad news argument, which is, I'm continually shocked that capital markets, financial markets are the only market that I can come up with where lower prices are viewed as a disaster as opposed to good news. When I walk into a store and I see a shirt on the rack that I like and it says 20% off, I'm pumped. I'm excited. I'm not upset about it. But when we walk into the stock market and we see a company we like and it's down 20%, we're, freaking out. So long way around the block to say, yeah, there's probably, and again, this is where the disclaimer goes. This is not financial advice. I don't know who's listening to this conversation, and every decision ought to be personal and predicated on your circumstances. But the reality is, at the margin, yeah, European stocks seem to be better priced with more margin of safety than US stocks, for example, US large caps. But we all know that there are many ways in which, saying that does not mean that there's a guaranteed loser and a guaranteed winner, because that's just not the way capital markets work.
Yeah, it all comes back to making decisions under uncertainty again, right? Those European equities are priced lower because there's a higher risk of something happening, but there's obviously probably more margin for safety on those lower valuations as well.
Yeah, it's the perception. I know you know this, but it's the perception of risk versus real risks, which is where people get tripped up, right? No one can come up with a bad outcome for US equities, and everybody can come up with 10 bad outcomes for European equities. So the perception of risk is the imbalance in the perception of risk is clear. I wouldn't necessarily conclude that it means that the true underlying risk distribution is that imbalanced.
But that's where you can probably get some of that arbitrage, right? From people's perceived risk and the actual real risk. So if you're willing to analyze that in detail. All right, excellent. I wanted to ask you as well before we wrap up, how can people find out more about you, Jonathan, and find out more about Treussard Capital Management as well?
Well, it's very simple. I'm on LinkedIn, and I encourage you to connect on LinkedIn and follow me. That's always great. I try to share as much of my insights as I can there. But importantly, please go to my website, Treussard.com. That's Treussard, for a bunch of reasons. One is to learn more about what I do and how I can help you with wealth management and financial advice. But equally importantly, and by the way, if you do, please contact me. There's a contact form. I receive those directly, and I will get back to you. But if you're not there in terms of having that conversation, please sign up for my newsletter at the prominently on my website. You can sign up for my newsletter, and again, one of the real privileges of running my own firm is I get to write as I see fit, a couple of times a month in a very direct and personal way. This is not your run of the mill wealth management or private bank type of dear sir, madam, stuff. And so if you want to hear more of my thoughts, I would love for you to sign up for my newsletter.
Excellent. Thank you, Jonathan. And congratulations on all your successes so far. And I wanted to say as well, I really enjoyed the conversation today. I think it was really great to go through all the talk about the markets and talk about bubbles. So I think the audience will get a lot from our conversation today. And I'll make sure that I also provide your details as well and how people can reach out to you in the information section below on our YouTube video. So thank you very much for our discussion today. And I hope, if you're willing, that sometime in the future you'd be willing to come back on and talk some more about the markets.
Absolutely. Today was a lot of fun, and I look forward to the next one.
All right. Thank you so much, Jonathan.
Thank you.